Some of the retailers take a hit. JCPenney and Lowe's are two of them. Not surprising, perhaps, that sales there plummeted in the fourth quarter as the recession deepened and unemployment accelerated. JCPenney now forecasting a loss for the fourth quarter. That would be its first in almost 5 years. And Lowe's says it's unlikely to meet analyst forecasts. Let's dig into this retail industry a little bit more with Burt Flickinger. He's managing director at Strategic Resource Group, which is a retail consulting firm. And obviously, these numbers not looking good, Burt. Which is indeed not a surprise. I guess the question is, any light at the end of the tunnel?
Julie, there's light for food and drug, and we have a report coming out on the stimulus package. But other retailers, a leading CEO told me over the weekend, there's no prize pony for shoppers or for retailers in this stimulus package. So hence, as you just referenced, Lowe's and JCPenney double-digit same-store comps. But like you referenced in your terrific interview with Professor Rubini earlier today with national debt and international debt, we look at debt per company. So Lowe's has very little debt compared to key competitors, and JCPenney's in the same shape. But if you look at debt to trailing 12-month EBITDA, some of, particularly Penny's key competitors, Nordstrom's and Dillard's and Bonton's are in really concerning conditions in terms of debt.
So at this point, then, it's just a matter of not figuring out where are we going to see sales improve, but just a matter of who is safe or, on a relative basis, safer from a Chapter 11 filing? Safer
from a Chapter 11 filing, Julie, and as you referenced in the beginning, Chapter 11 for consumers, Chapter 11 for retailers, and Chapter 11 for REITs, because the shopper's never been more cash and credit constrained. So we're in a 1,000-day retail recession. We're only 450 days through it right now.
So if you look at something like a JCPenney or a Lowe's, which, as you said, have less debt than some of their competitors, does that mean then that they could be a good investment potentially and that they could stand to benefit if some of their competitors do go under?
Julius, we reported with you and Betty on Bloomberg 12 months ago when Wall Street analysts were leading institutional and individual shareholders to the slaughter on both names. We said run from retail, these companies and other companies. We would say because of the stimulus package, there is going to be light because of competitive contraction for drug retailers like CVS, food distributors like SuperValu. You also see regional and national food retailers like Village, ShopRite, division of Wakefern and ShopRite that's public, and also Kroger having a chance to do well as people are cutting back on discretionary spending and only spending on essentials.
If you're a long-term investor, though, why not take a look at some of these clothing retailers, for example, that eventually, if they're going to survive, that they will rebound?
Julie, on other networks, we hate hearing the pundits say if you have a 5 or 10-year horizon. Our thing is not asset diversification, it's asset preservation. So as Betty just referenced, we would say maybe gold, but as Louise Yamada's shop reported, gold's a little high. We would also counsel to go with grains and benefit from the food cycle. Some of the food manufacturers who are going to benefit, Smucker's will benefit, companies like that, selling a lot of peanut butter and jelly as people are moving down from meat to poultry to pasta to peanut butter and jelly.
Okay, Burt, thanks a lot for coming in to talk with us. Appreciate it. That was Burt Flickinger, Managing Director at Strategic Resource Group.